Hello, my name is Elliott Gue. I'm editor of Personal Finance as well as the Energy Strategist. Today I want to talk about a market that many investors like to hear about all the time, which is oil. Oil is probably the most recognizable energy commodity out there. And what a lot of people haven't really focused on is that it's actually lagged a lot of other commodity markets this year. Gold prices recently touched new highs, over $1,400 an ounce. We've seen big run-ups in corn. We've seen big run-ups in soybeans. Oil has actually been kind of a laggard this year. It's not trading much higher than it was at the beginning of the year. And until very recently, it was still trading under its April highs. And what we're now seeing is oil begin to push a little bit higher. I think that's going to continue. And generally speaking, I think you're going to see $100 oil either late this year or early next year. That's really not a new prediction for me. I've been saying that since the end of last year. Predicting that oil would top 100 by the end of 2010. That's still possible, I believe, and if it doesn't, I think I'm only going to be off by a month or so. What's happening in oil? You still hear on the media a lot of people say, well, global oil demand is sluggish as a result of sort of a hangover from the 2007 to 2009 recession. Well, that's very interesting because the Energy Information Administration and IEA, the International Energy Administration, actually came out saying that oil demand in the third quarter globally was at a new quarterly record, all-time record. And I think that oil demand on an annual basis in 2011 will surpass its prior peaks and be at a new all-time high. Now, of course, as I've been saying for years and years, most of this growth has come from and will continue to come from the emerging markets. Countries like China, India, seeing strong growth in oil demand, and that's certainly reflected in the International Energy Agency statistics recently released. But what I think has really been a big surprise is demand from your developed countries. A lot of people were saying, well, U.S. oil consumption growth is going to be sluggish for a whole variety of reasons. Weak economic growth being the number one. Some people also talking about this big increase in U.S. energy standards, energy efficiency standards, cutting into demand for oil. Really, we're not seeing that. Oil demand has been quite strong in the U.S., and we're actually seeing across the developed world a big resurgence in oil demand in the third quarter of 2010, and early statistics showing that continuing really into the fourth quarter. So we're kind of firing on all cylinders here. We've got continued strong growth in demand from your emerging markets, coupled with pretty strong demand growth, or at least a pickup in demand growth from your developed world countries. We're going to see very strong energy demand growth, really the fastest year-over-year increase in global oil demand since 2004. And that's a statistic that still a lot of people find very surprising, given the sort of media conventional wisdom, which is just plain wrong and not reflected in the data. Now, how about everybody's favorite oil topic, inventories? Yes, obviously, oil inventories in the United States are still a little bit bloated. However, they're coming down, and in the third quarter of 2010, worldwide, in your developed countries, your OECD countries, we actually saw a draw in oil stocks, in oil inventories. And that suggests, again, that reflects the pickup in demand. It also reflects tightening supply side. We've seen really falling production from your OPEC 11 countries. That's pretty much everything in OPEC except for Iraq. All those countries are cheating. They're producing a lot more than their official quotas, but their actual production has tailed off here a bit over the last 3 or 4 months. And also what I think you're not going to see is them boosting their targets anytime soon. That'll probably happen sometime early next year, if then at all. And what that means is that we're going to see a tightening in OPEC spare capacity. If they're not producing more oil to supply the world market, that's going to cause a draw on inventory statistics. When they are eventually forced to hike production targets to sort of meet growing global demand, then that's going to cut into their buffer, their spare capacity buffer. That tends to be very, very bullish for oil prices. So I think you will see rising oil prices throughout 2011. Certainly you're going to see corrections. Oil's run up a lot here in the last few weeks, but I think generally speaking, you could be looking at oil prices well above $100 by the end of 2011. That's going to be highly supportive for your energy stocks. One of my favorite sectors within energy lately is the oil services sector. These are companies like Schlumberger, symbol SLB, Weatherford, symbol WFT. These companies really provide the technology needed to produce global oil fields. They do things like managing drilling of particular wells, and these wells are extremely complicated compared to what was happening, say, 10 or 15 years ago. Companies are drilling in deep water environments. They're drilling wells in very high pressure, high temperature reservoirs. They're drilling long horizontal wells. Even onshore in the United States, people are drilling wells with lateral segments, horizontal segments of more than 10,000 feet. Very few vertical wells being drilled in these unconventional plays that you hear so much about, like the Bakken Shale and the Barnett Shale and the Haynesville, Eagle Ford. All of this is really horizontal type oil plays. Services companies benefit from increased well complexity because they're the companies that have the technology to drill those wells and to complete those wells. So we're seeing a real boom in demand there. Already those companies are firing on literally all cylinders in North America. The accelerated development of oil and natural gas liquids plays. These are shale plays that produce oil and natural gas liquids, again like the Bakken. Strong demand growth there is producing a real boom in pricing. Some companies are talking about pricing for key services being up 50% since April of 2010. So that gives you an idea how tight that market is. Looking internationally, it's been pretty sluggish actually, picking up after the 2007 through 2009 recession. Oil companies saw that big collapse in commodity prices at the end of 2008, early 2009. Kind of put them off ramping up their investment quickly, but we're beginning to see that. And early in 2011, we're going to see a lot more of that. Some international markets like Brazil are firing on all cylinders. Others look to be ramping up a lot next year, Iraq being a big example of that. And this is going to spell rising revenues and increasing tightness in the international oil services market. Once both of those sectors, North America and international, are firing on both cylinders, you can expect a lot of pricing growth and an environment very much like the 2004 through 2007, 2008 period for these companies, in which at which time period a lot of these companies were up 300 to 500% in just a few years, and I expect similar types of returns out of these companies, going forward. So bottom line, oil prices are headed a lot higher. Don't believe what you've heard on television about oil demand being weak. Actually hit a new all-time record globally in the third quarter. Supply growth pretty sluggish, especially from OPEC. A lot of these new supplies you hear about, like Iraq, are going to take many, many years to bring online. And even the Iraqi government has revised lower their ultimate expectations for oil production. This creates a great environment for buying one sector in particular, which is oil services. Look at companies like Schlumberger, symbol SLB, and Weatherford, symbol WFT. Thank you very much.